Why is Warren Buffett sitting on over $300 billion in cash instead of buying stocks? Why are the smartest investors in the world hoarding money while the market breaks records? They know something. And today, I'm going to show you exactly what they see and why the stock market, by every historical measure, every warning sign, every rule that's ever mattered, should have already crashed into pieces. Stay until the end because I'll reveal the 3 signals that will tell you when the crash is actually coming. Let's go. Let's start with something Warren Buffett loves, the Buffett Indicator. It's simple. You take the total value of all U.S. stocks and divide it by the size of the economy, the GDP. Right now, the stock market is worth about $66 trillion. The U.S. economy? Around $30 trillion. That's a ratio of 220%. Here's the kicker. Anything above 100% means the market is overvalued. In 1999, before the dot-com bubble exploded and wiped out 60% of the market, it was at 115%. In 2007, before the financial crisis, it was around 110%. Today, it's more than double what it was before those crashes. Now let's talk PE ratios, price to earnings. It's like asking, how much am I paying for each dollar this company makes? Normally, a healthy number is 15 to 20. The top companies in the S&P 500 right now, their average PE ratio is 66. That means you're paying $66 for every $1 of profit. It's like buying a $5 coffee for $330. Insane. And here's what makes this even crazier. While Buffett and the big institutions are pulling back, retail investors, regular people, are piling in at record levels. In 2023 alone, individual investors poured over $1.5 trillion into the stock market, more than any year in history. They're buying at the top, convinced that stocks only go up. They see headlines about AI, about generational opportunities, but what they don't see is that they're the last ones holding the bag. History shows that when retail investors flood in at peak valuations, it's not the beginning of the rally, it's the end. So if the numbers scream bubble, why hasn't it popped? Here's where it gets wild. The U.S. government collects about $5 trillion in taxes every year. But it's not just spending $5 trillion, it's spending $7 trillion. That's a $2 trillion deficit, borrowed money, money that doesn't exist yet.
It floods into the economy, into corporate earnings, and directly into stock prices. The market isn't rising because companies are suddenly twice as productive. It's rising because there's more money chasing the same assets. It's a balloon that looks bigger, but it's just full of hot air. But there's a trap inside this system. The U.S. government owes over $35 trillion. The interest payment alone is around $1 trillion a year, more than the entire defense budget. So the government is trapped. Borrow to spend, pay interest on the borrowing, then borrow even more to pay that interest. It's a financial treadmill that's speeding up, and the only way to keep it running is to keep printing money. The moment they stop, the whole system seizes up. And why are they doing this? It's a geopolitical chess game. Since 1945, the U.S. has been the global superpower. The dollar was king. But that era is ending. China, India, the BRICS nations, they're all building alternatives. The world is fracturing. So the U.S. made a choice. Spend whatever it takes to stay on top, even if it means borrowing from the future. Because losing global dominance would cost far more than a few trillion in debt. So, you're not waiting for the crash. You're watching for the trigger. As promised, here are the 3 signals that will tell you when the real crash is coming. First, the money printer stops. They can't stop yet, but they will be forced to, either by runaway inflation or a foreign nation refusing to buy U.S. debt. The moment the flow of new, borrowed money dries up, the illusion of growth shatters. Second, the retail exodus. The same people who piled in at the top will be the first to panic. Watch for headlines about record withdrawals from stock funds. When the last buyers turn into panicked sellers, there's no one left to prop up the price. And third, a geopolitical shock to the dollar. This is the big one. Watch for a major nation like Saudi Arabia or another BRICS country to announce they are no longer accepting US dollars for oil. That's not just a headline, it's a direct challenge to the system that's propping everything up. When you see these signals, know that the smart money has long gone by. The doors are about to close. The question is, will you be on the right side of them?
Let's continue with the next section, the hidden engine. When the government floods the system with borrowed money, it devalues the dollar. I want you to picture this. There are 10 apples and $10. Each apple costs $1. Simple. Now imagine there are still 10 apples, but suddenly there's $20 in the system. Each apple now costs $2. The apples didn't change, the money did. That's inflation. That's devaluation. And it's exactly what's happening right now. And investors, they know this. They aren't just betting that companies will innovate and produce more, they're betting that the dollar itself will be worth less tomorrow. So a company with a crazy high PE ratio of 66 today might actually look normal in a few years, once inflation chews through the value of a dollar. Think about it. A company sells a product for $100 and makes $10 profit. But if inflation pushes that product's price to $200, the profit becomes $20, and the company didn't have to do a single thing differently. All those sky-high valuations suddenly start to make sense. This is the hidden engine. The market isn't crashing because it's being artificially inflated by a weakening currency. It's not real growth, it's a monetary illusion. And here's the brutal part of this illusion. Let's talk about the wealth gap. Who actually owns most of the stock market? The top 10%. And the bottom 90%? They own next to nothing. So as the dollar loses its value and stocks soar to new heights, the rich get richer. Their portfolios inflate. But what about the average person? Their wages are stuck, their rent, their groceries, their gas, it all gets more expensive. They fall further and further behind. This is exactly why it feels like the economy is broken, even when you see headlines about the stock market hitting new records. Because for most people, it is broken. The system is working perfectly, but for the few, not the many. Warren Buffett sees this. He's not buying into the hype. That's why he's sitting on a mountain of over $300 billion in cash. He knows this party can't last forever. He is waiting for the correction, for the crash, so he can sweep in and buy valuable assets at a massive discount, just like he did in 2008.
He's patient, he's prepared, he's playing a game most people don't even know exists. But there's one more dirty trick keeping this market afloat: corporate stock buybacks. In 2023, S&P 500 companies spent over $800 billion buying their own shares. Why? It's simple market manipulation. When a company buys its own stock, it reduces the number of shares out there, which artificially boosts the stock price, even if the company isn't growing at all. It's financial engineering, not real value creation. And who benefits? CEOs with stock-based compensation and the wealthy shareholders. That $800 billion could have gone into research, raising employee wages, or true innovation. Instead, it was used to prop up stock prices and keep this illusion of growth alive. It's another pillar holding up the market. Companies themselves are creating artificial demand. But this can't last. When earnings finally disappoint or the cash runs dry, the buybacks stop and the floor drops out. So when does it crash? When does this all end? Here are the 3 signals you need to watch for. Signal number 1, the Fed stops printing. If the government can't keep borrowing and spending at this insane rate, the money flow stops. The balloon deflates. Signal number 2, inflation spirals out of control. If prices rise so fast that people literally can't afford the basics, consumer demand collapses. Companies earn less. Stocks fall hard. Signal number 3, a geopolitical shock. A war, a major energy crisis, a breakdown in the financial system. Any major disruption could be the single pin that pops this bubble. We don't know when, but we know why it hasn't happened yet. And we know it's coming. So here's the truth. The stock market hasn't crashed because it's being held up by government spending, dollar devaluation, and the calculated bets of the ultra-wealthy. It's a house of cards that looks solid until the wind changes. You can't control the system, but you can control your response. Educate yourself, diversify, prepare. Drop your thoughts in the comments, subscribe so you don't miss what happens next. And remember, I am not a financial advisor. This is education, not advice. Your decisions are your own.